Hey everyone, KYT here. I'm back from vacation, but it did take me a few more extra days, or even we could say a week or two, to get back into the swing of things and to make another video. But hopefully you guys can appreciate it. In this video, we're going to be talking about stuff like CASH.TO, vehicles that people should consider putting their short-term savings into. But before that, I want to mention how sweet my vacation was. I went to Thailand, I visited Cambodia for a few days, and then I spent a week in Hong Kong. And if you check out my Instagram, you can see a lot of different foods and sites I was able to see. And it was tough to bring my daughter, but it was worth it. I mean, having her sitting, just having her, not having her own seat, but sitting on my wife's lap through over 10 hours, not something that I want to do again. All right, let's get back to business. Well, I said we're going to be talking about Cash, and I think it's a great name, easy name. There's many different companies that have come up with similar products, but this one has the easiest to understand and remember name. So Cash, let me read its investment objective. Cash seeks to maximize monthly income for unit holders while preserving capital and liquidity by investing primarily in high interest deposit accounts with Canadian banks. And if you scroll all the way down, you can see where it's putting your money into the top 10 holdings here. There's only 3 banks. It's going to put your money into the National Bank cash accounts, CIBC, and Scotiabank cash accounts, all their high interest savings. And the point is that while in stocks, 100% stocks, like myself and XQT, you can lose money here. You can preserve your capital and gain an interest. And if you've heard that rates have been constantly going up or really high over the past year, you can see why these products are more and more popular. In fact, if I scroll all the way up here, it says 5.36%. That's based on the last distribution, so it can change month to month. As we know, interest rates can rise depending on the Central Bank of Canada, and it could go down. But based on the last number, you can, and project it across the whole year, you'd be getting 5.36% on your money, which sounds pretty good. If you consider the fact that 8 to 10% with stocks is considered really solid, having a mostly risk-free 5.36% sounds really attractive. And when you scroll through the cheat sheet that I made, that's linked in the description below, that took from Justin Bender the different all-in-one ETFs you should put your money in, this is based at minimum. You should probably be looking at 5 years of investing time. So what should you do when you have less than 5 years to invest the money and you want it to be safer? Or for example, you have a down payment that you need to preserve that you want to probably use, you're already actively house searching, then you would put it in GIC or in Cash.TO. Now, a question that I see asked a lot is, why does the graph look like this? And they're freaking out. Honestly, people freak out. But if you understand dividends and distributions, this should look really normal, and it should be pretty predictable. You put your money into cash, it goes up, and then once it's time to give you that monthly distribution, it's going to drop down. And so you're going to have the money that you have invested, and then that distribution is going to come to your account separately that you can then cash out if you want to, or reinvest into Cash.TO, or invest into something else. So it really makes sense. It's predictable, and especially when the interest rate has been pretty stable over the past couple of weeks and months, it's going to look like that. Basically, if you stretch it out, you're going to have periods of smaller distributions when interest rates were a bit lower, so you're going to make less per month. But when the distribution is higher, the interest rates are higher, you're going to make a lot more. It's like it goes up higher, and boom, it comes back to roughly $50. And often some people think that they can sort of game it by timing it of where you buy and sell. And again, as long as you buy it during open market hours, it doesn't really matter. It's going to come down to the same thing. Naturally, another common question is if putting a lot of money in Cash.TO is really safe. And the answer you're going to get from a lot of people is that it is quite safe, basically extremely safe, because you're putting your money into Canadian banks, and Canadian banks are highly regulated, which is why they are known to be a lot more safe than, let's say, US banks, and they are far less likely to implode. But there are other options that are considered even safer. And the safer option is funnily also provided by Horizons. Now, Horizons came out with this in April 12th, 2023, so very recently, called CBIL. If we read this here, CBIL invests primarily in short-term government of Canada T-bills, which are backed by the credit of the Canadian government. CBIL's yield is generally anticipated to increase or decrease depending on the prevailing interest rate environment in Canada. So they're going to perform very similarly, except that CASH.TO is probably going to perform a little better because it's a little bit riskier. And I asked my friend ChatGPT to explain why it's a bit riskier. Very simple explanation by it. Yes, bank deposits in Canada are generally backed by the government through the Canada Deposit Insurance Corporation, CDIC, which ensures eligible deposits at its member financial institutions in case of their failure. However, the protection has limits. For instance, it typically covers up to $100,000 CAD per insured category per depositor at each member institution. Investments like treasury bills, T-bills, which CBIL ETF holds, are direct obligations of the Canadian government. This means they are backed by the full faith and credit of the government itself rather than relying on insurance schemes with specific limits. This direct backing is often viewed as safer because it is not dependent on an insurer or a set of insurance rules and limits. The distinction is that while both are very safe, T-bills are direct government debts, making them one of the safest investments available. So if you are worried, a little bit worried, put it on a CBIL. It's pretty close, the distribution you're going to get, and you can sleep easier at night. So it's a pretty good tool. These tools, CASH.TO, CBIL, GICs, there's a lot of tools to have your money be in a safer part of your portfolio if you need it that way. Again, if it's money that you need within 5 years and the money you need for an upcoming deposit, but you don't want your money to just sit there not gaining any interest, these are awesome options. But why is it that I don't have anything in CASH.TO? I'm still personally 100% in XEQT because if you look at this graph from the Credit Suisse Global Investment Returns Yearbook 2023, which you can Google and find, it has a lot of interesting graphs and data over a huge sample size. So over a sample size of over 100 years, 122 years to be exact, mapping different interest rate environments. The higher the interest rate, the return, the darker blue is the equities the next 5 years. So the return of stocks in the next 5 years is higher as the interest rates gets higher, and bonds as well. Now that makes sense to me. Moving forward, like your stocks and everything go down in value as the rates go up, but then moving forward, the expectation is that you should get a higher return percentage-wise than the interest rate. So by putting my money into XEQT, on average, it will perform better than CASH.TO, even though cash is really high at over 5%. And you can see that why that is. If you look at XEQT, I think for the year it's up around 10%. Let me look that up. So yeah, XEQT is up 11.76%. But it's important to keep in mind this is next 5 years, and it's again an average, meaning there are many periods of time when it does a lot worse than just having it in CASH.TO. So it's a matter of risk tolerance, how much it comes down to the same question for a lot of different scenarios, like whether you should lump sum or DCA. One approach has an average, like a higher average expected return, but has higher lows as well. Because when you think about it, why would anybody want to invest in stocks if they're a lot riskier when you can get a safe, smooth 5%? It's because stocks have a higher average return, but that comes with higher risk. And now is a good time to be in stocks if you have a lot of money, just because of this higher expected return. Now that it's at 5%, and once those rates start looking like they're gonna turn the corner, and it's looking like the market's already pricing that in. That's why it's been such a good week. This week, I think the returns are gonna be tremendous, and so that's why you don't wanna miss it. You just wanna keep piling money, and as usual, just don't time the market, just keep buying. And with that, that's my return video. Hopefully you guys enjoyed it, and hopefully I get to see you guys in the comment section. You guys know I answer every response, every single question. So I look forward to seeing all of you there. See you in the next one.